Good afternoon, everyone, and thank you for joining our tax planning webinar today. We have James Johnson and Ed Thaney to walk you through our presentation, and James will kick it off with some housekeeping notes and then dive into the presentation. So please enjoy.
Hello, everybody. Thank you for joining us on our 2022 Thaney & Associates Tax Planning Webinar. I'm joined by Mr. Ed Thaney, CPA, CVA with Thaney & Associates. My name is James Johnson. I'll be helping to guide us through the tour. Hopefully today we can give you some very good tax planning strategies and helpful hints for your business. That's the goal anyways, and we greatly appreciate, of course, your time for this and want to make the most use of it. And it's a very short time, so we're going to try to get through it as quickly as possible and highlight some key takeaways, key business and tax strategies for you. So let's just dig right in. Let me just start off. My background, I've been a CPA for my entire adult life, so I have quite a diverse background in public and private practice. And Thaney & Associates, their motto is we're trying to be partners with you to help you build your business and save money with taxes, and we see you as partners in this strategy. Anyways, let me introduce then Mr. Ed Thaney. He has over 30 years in this as a professional CPA, so he has lots of great business insights, and we'll get started. Go ahead, Ed.
Thanks, James, and welcome everybody to our webinar for tax planning. As you know, many of you know that we're a full service CPA firm. We're doing work in over almost every state now with the remote world that we're living in right now. And we have 3 offices in Florida and 2 up in Western New York. Again, we've had over 30 years of tax planning experience, and right now, this is the time of the year we are doing a tax planning season. So some of you people that I think are registered are involved with that process now. If anybody else is interested in it, please give us a call. And again, what we always say is that on January 1, we become historians. We can't do anything about the previous year. So that's why between October 1 and December 31, we're busy trying to be proactive for you and your taxes. We also own a few other entities that we are really related to the CPA world. Elite Business Solutions is a virtual bookkeeping and CFO services for small businesses with bookkeepers and government accounting specialists throughout the country. Their MBAs and CPAs basically working virtually into companies and outsourcing their actual books and records and all their recording of all their entries, and even full service as far as billings and collections and all that. We have a franchise called Trans World Business Advisors, where we help clients that would like to buy or sell a business. We have certified valuation analysts on staff providing valuation and due diligence work. That has a lot to do with our strategic planning and our succession planning with the clients to have the full service of the business cycle. Biz Collections is another entity. It's a third-party debt collection company assisting with bankruptcy alternatives and debt restructuring. And last but not least, we have Clear Choice Capital, which is a third-party small business loan agency. helping to facilitate SBA loans, equipment loans, lines of credits, and other small businesses. TLR is the last but not least. Technical Learning Resources is a publishing company that does QuickBooks training guides for schools, adult classes. They do the professor and the student editions. We also do some specialized modules that we have right now. One big one that's we're doing webinars on right now is QuickBooks Online and how to use that. And we have some specialized industries right now. We have law and construction. We normally take the flavor of what else is needed out there. We have some licensing contracts with Intuit regarding QuickBooks. So I know it's a lot to swallow. If you'd like any more information on any of these, please feel free to follow up with us. Thank you.
Great. There's a little bit about us and affiliated companies also that we'd like you to know about. We are completely virtual and can work with clients in any state. We do have physical offices also in New York, Orlando, and we have 3 or 4 other physical locations, professional offices that you could meet us in. But just to let you know, because of the COVID and everything, we've been able to operate on a virtual basis with our office, and but also we do keep those locations as well. Let's click on to our overview. Importance of tax planning. This is a tax planning webinar, so that's going to be the main focus of the webinar today. We've thrown in a few nuggets of very useful information for you, tax savings for you. So we want you to judge us by the results we're going to get for you and the dollars that we can make for you. These are real dollars and real ideas that are going to be very practical for you and can be implemented right away. But there are things that we see in our practice that a lot of people may not understand. So we just want to go over them, and we understand we have a very sophisticated audience today, but so we're going to try and glance over kind of some of the basic things, but then maybe dig into a few items that would be a lot more helpful for you. Let's go to the next slide. Questions, please submit them. We would love to hear what you're thinking about the webinar and about our business. And please go ahead and submit those at any time during the webinar, and we'd be happy to answer those. We're going to collect those and answer those at the end of the webinar because of the time constraints, though. We got to get through this kind of quickly as time is of the essence. Okay, let's go to the next screen here. Importance of tax planning, of course. We want to do it as much as possible before December 31st, as Ed said. After January, it's not going to be a good thing. Especially, we're focusing primarily too on businesses need this more than a lot of people. I mean, everybody could use it, but businesses especially if there's been major changes with your financial situation from the prior year. We'd like to take a look and see how things are going with your assets, purchases, income, just your net income, I guess. And so what we do is we'll run different scenarios for your tax planning to help figure out maybe what would be some good strategies you could use. Tax planning is important every year. Whoops, flipped the page too soon. And there's some things the last few years we've been working with the ERC credits, the employee retention credits. That's still an ongoing process, and will be. It actually starts to phase out starting in March of next year, where you're allowed to go back and amend your employment returns. So we want to make sure if you think there's a chance you could get one of those, we please contact us. So now basically on the ERC, there's going to be a couple tests. Your business has to have been shut down by government mandate at some point during the pandemic, or there's a revenue test also that we can use to calculate if you would qualify. But it's basically if you were severely damaged during the COVID pandemic, there's a very excellent chance that you would qualify for these credits. PP loans program has closed down as of last year, but there's still loan forgiveness issues and then reporting issues, so it's not as big this year as it was last year. And then there's some proposed changes. We'll brush really quickly through those at the very end. And well, let's move on to the next slide. Okay, so a basic idea that we always give to everybody is to, if they need to get some more deductions, if they're bumping into those higher tax brackets, we definitely would recommend them to make some last-minute purchases this year. Especially if they're going to plan on buying equipment next year, try and move those back. So that's a fairly standard and basic tax planning procedure that we're going to recommend for a lot of our businesses if they're running into trouble with the tax rates. The retirements plan is we have a whole palette, a big list of different types of retirement plans. 401ks and simple IRAs, 401ks, SEPs that we can use with different, depending upon where you're at, where your business is at, and where you are at personally. We can evaluate that situation for you to find out what would be the best going forward. They all have different requirements and minimums and things that need to be met on those. So we got to kind of customize that. There's not necessarily going to be a one size fits all for that question. Whoops, I don't know why that flipped. I did not mean to flip that. Whoops, where? Oh, wow, I went too far down. Okay, officer compensation, red flags, that's a great area. I love talking about that area, but I think we'll skip it today. But basically, that's those types of situations come in for S corporations primarily is where I see that happen a lot with a lot of the clients. There's different games, I guess you'd call it, cat and mouse games that people play with IRS, and this is one of the hot areas they will look at. So we kind of don't want to red flag our returns to get audited. And actually, on that note, I would like to say that the IRS does not like to audit the CPA firms as much as, substantially less, because they just know that they're not going to be as successful. So we have an excellent record for keeping people out of trouble. I know that's a big issue with we hear from people that they're so happy that they haven't run into audits, especially like the higher income people that we deal with. Cash versus accrual method. Oh, whoops. If there's issues with seasonality for businesses, things like that. Sometimes if there's a large amount of revenue that's been accrued at the end of the year, so to speak, we may want to then go ahead and flip you over to the cash method. Now, it's a little bit of trouble in filing to get that, but it might be worth it depending upon the business situation. So we'll look at that, evaluate that for you. The 20% QBI deduction, not necessarily that we can plan it for it. It's just that we have it in our calculations when we run our scenarios on the software. So,
And
and that
James,
will, of course, yeah, go ahead.
let me just speak on one thing there about our
Absolutely.
planning and all that and what we're doing now. Those
Absolutely.
first four items that James has mentioned is really the roundabout of our year-end tax planning. Again, the purchases before the end of the year with big equipment or even automobiles or transportation equipment in excess of 6,000 pounds, going through those retirement plans. That red flag for officers comp is just what during planning we do all those testings to make sure you're in a safe harbor with the IRS. And then cash versus accrual we look at all the time. Again, if you have big receivables that you're being taxed on under accrual basis and low payables, then there's a conversion that's allowed. And just recently, a couple years ago, or 3 years ago, I think it was under Trump, the extension of that was increased to companies that have gross volume over $25 million. You could look at it and convert it to cash basis from accrual basis. So that's the nutshell of the planning too that we get involved with too. Thank you.
Really excellent. Really excellent, Ed. And also, these are some of the other ideas we have, and we're going to give you customized ideas when you come in and do planning with us. We're gonna get to know your business and what's specific for you, and it's really has to go business by business because every business is its own unique operations and entities and operation style and different P&L, and so there's every business has to be looked at kind of separately in relation to how that is with its owners, and that's really the only way we can come up with really a good plan for everybody. But nevertheless, these still are great ideas, even if we couldn't get a chance to do something like that. Let's move on. The next, okay. These were some ideas I thought would be important to look at. This isn't necessarily a tax planning idea, but I think it's important enough to bring, just to quickly mention in the seminar, the 4 pillars of wealth building. You are having a business, having some real estate, having I put precious metals ahead of the paper assets, but if you have, these are the 4 legs to your financial table, and so if you're missing out in one of these areas, it's a good idea. This is very top level thinking for your long-term wealth building and this is how the wealthier people do it is they just start investing in these different things that will generate passive income for them, and over the years they build this stuff up. This is kind of how it's done, ground up. So this is actually really good, solid information. It's simple. It looks very simple, but just this idea is, I think, very, very powerful. So don't underestimate this one. It's very good. So anyways, oh, geez, I can't do this slide. Here we go. Okay, so let's these other bullet points don't necessarily relate to the heading, but I thought they would be important. Some big ideas that's been that I'm very excited about that's actually come up in the last year or two is the SALT deduction, which is the state and local tax that normally, traditionally, we take it on our Schedule A on our tax return. But now there's a window of opportunity for us to take it. We can take it outside of that and take it on a business tax return. So in New York, it's called the PTET. You have to elect it every year. And what's really great about this is it basically is taking a deduction that really you're not going to get, or I haven't seen people get the full amount of the deduction because the standard deduction has been raised up to Well, this year it's going to be 27,900. So because the standard deduction has been raised so high, most people don't, that I've seen, even multimillionaires aren't aren't able to itemize, or if they do itemize, it's barely over that standard deduction. So they're really not getting the benefits that they used to from the state taxes, from the charity deductions, and from the health deductions. So, but what's great news is, and we've been using this with our clients, is the SALT deduction. If you pay that through a pass-through entity like your partnership or your S corporation, you can elect to pay that. You can deduct it in your S corporation. So you get the full deduction, whereas if you try to itemize it, you wouldn't get anything for it. So this is a great tax saving. So, for example, if you had $10,000 of state taxes, for example, in New York, and you would pay it using the SALT election through your entity, and then you would get that 10,000 deduction. So if you're in the 32% tax bracket, that would be $3,200 that you would get for basically the same amount of money. You didn't spend anything more or less. It's just we moved it from your Schedule A over to the SALT. So this is a great tax planning, is thinking how we can get the itemized deductions that normally you would want to put on Schedule A, trying to get those moved off the Schedule A and into something else. The self-employed health insurance deduction is a similar idea. That's really nice. So for self-employed people, you have to have self-employment income, which means you're subject to that FICA tax. But if you have that, then you can deduct your health insurance, again, not on Schedule A, but you're going to deduct it directly on the front of your tax return, so it's not subject to those limits. So that's a really nice little, I don't know if I call it a loophole. What's interesting is you could choose to put it on Schedule A, or you could choose to take it as a self-employed health insurance if you knew it existed. So which we're telling you it does. So that's where we want to put that. Here's a kind of a nice one. This situation actually comes up, or actually I've seen it a few times. So it pays to be married. So there's the lifetime gift and estate tax exemption. I believe it's about $12 million and something this year. So if you're married, it goes up to $24 million. So this is for the high worth individuals. So if your estate is $15 million or $18 million, and if you're married, then that's all going to be, you don't have to worry about that huge 40% state tax hit. But if you're single and you have, a $20 million estate, then you have a little bit of a problem. So I guess we could say here, husbands, be nice to your wives if you're in that tax bracket, because it really that amounts to quite a bit of money there that you're leaving on the table if you don't if you're not married. So but you'll have to get it. Oh boy, my screen flipped off. But you'll have to get it, of course, legalized. The attorneys have to draft it correctly, so that there's portability issues and there's other issues. And I'm sorry I'm using these big words, but I think we're speaking to a sophisticated crowd here. So I'm sure they're getting a lot of this. I wanted to highlight
let me just add
one
little thing on that.
Yeah.
With the estates, is I think for 2022 that exclusion is $12,200,000 or $300,000, projected to go to $12,900,000 in 23. But in 25, these escalations right now die and could go back to, we've seen anywhere from $3 to $5 million. So these are the times that you may want to consider if you're above 3 or 5, thinking you're safe, you might want to consider some planning for 2025 and keep that in mind. Thanks.
Right. Excellent, excellent idea. I think we might be hitting that on our next screen. So let's real quick. So the 32% tax bracket. So it starts at about 170,000 for the singles and 340 for the married, plus all the other taxes we pay on it. So I just wanted to highlight that tax bracket simply because of that's a bigger jump from the 24%. It moves from the 22% to 24, and then all of a sudden it jumps up about 8%, and so you're starting to pay some real taxes when you get here. So when our partners, I call you guys partners because that's the way we see you, start to get in those higher tax brackets, that sends a red flag for us, or the red signal starts going off. We got to start looking a little bit harder at these tax planning issues and seeing if we can start implementing them. We're not as concerned at the lower levels, the 10 or 12% levels, or the 22% levels. I was going to cover about the real estate. There's bonanza and inflation. The top long-term capital gate rate remains at 20% this year. I think I got to skip a lot of that. That's a whole nother seminar. Basically, the real estate professionals who are investing in the real estate and owning the real estate and selling it, it's a whole different kind of scenario, business-wise and tax-wise, that they live in than the rest of us. And so there's a lot of advantages there to looking at that, the real estate, having some real estate in your portfolio. In fact, traditionally, this is how millionaires have made their millions. Most millionaires have become millionaires, at least in part through real estate. So it's something to consider adding to your portfolio if you hadn't, not just for business reasons, but also for tax reasons are very favorable for real estate. But again, we don't have time to go into all the little nuts and bolts of that. Let's on to the next thing. Retirement plan contributions. That's a major so we're on to individual tax planning ideas. Retirement plan contributions is one of the major areas we look at, and it's fairly straightforward. So your contributions are going to be tax-free. In other words, instead of having $100,000 in wages, you're going to reduce it by your contribution, and then that's basically how that's going to work. And then there's different, of course, the different plans that are available, like we had covered before. And then here's a nice little example of the different levels of contributions you can put in to. You could get totals around $64,000 for these types of plans. There's plans for high wage earners that can go even higher than that, but it just depends upon how much money you have available and where you're at. College savings plan, not deductible for federal, deductible in a lot of states, but the earnings aren't going to be taxable for federal or state, for sure. So that's kind of the benefit here. If they're spent on college, not spent on a party or something. So now we're down to the the health savings accounts and the flexible spending arrangements for health. So these will give you deductions and tax benefits. I don't have my notes pulled up on all the specifics on those. What happened? I flipped. I think we were done there. Qualifying opportunity zones still exist. You have to get there's so many in the state. We have to apply for those. Those are great potentially good areas for tax savings for for your local areas, for real estate investment. But those are whole specific programs, but those are things to consider. Let's move on then. So finally we get to there's our gift and lifetime estate exemption. There's the amount, 2022. Like Ed said, it is set to sunset in about 2025. But a lot of times these things are renewed. We just don't know. We can't predict next year on some of these tax laws, let alone 2025, because they're constantly tinkering with everything. So the idea here is if you do have the larger a lot of wealth, you do want to start transferring it as quickly as possible down to the next generations. And of course, one of the things the annual gift tax exclusion was raised to the $16,000. So if you are in that boat, you want to gift out $16,000 per person to your children and your grandchildren. If you're married, you can double that for each child or each grandchild. So that's a great estate tax minimizing strategy. State taxes are pretty hefty, and so this is one way we used to avoid it. You can use different types of partnership setups and things like that to get out of it. But again, we're just going over a few ideas here. So the NOL rules, we did have the 5-year carryback, but not anymore. Now we just have indefinite carry forwards. There's offsetting gains, check withholdings. We can look at that for you. So that has to do with payroll taxes and things like that. Just adjust your payroll. We can help you with that. That's minimal. Let's move on. Ed, are we covering all the bases here, or because I think we're almost through?
Yeah, I think so. I think some of the things that you had mentioned are good. The FSA accounts went up from I think the 2,850 to 3,050 for this year, and the HSAs have gone up to 7,300.
Yeah, so, the HSAs are going to be your higher deductibles type insurance plans. FSAs are more, anybody can sign up for those. For the lower deductibles who have maybe more health care costs during the year.
Correct.
Okay. Let's move on. Okay, so these are just the proposed tax changes. Ed, can you see the screen okay?
Yes.
We're on the proposed tax changes. I don't know if I don't really, since it's all proposed, I don't know really where they're at in that process. But I usually don't spend too much time on the proposed until they actually come through, unless it's something. Well, just to be aware of, the capital gains rates may go up to 25%. And there might be a capital gains here for unrealized gains above $1 million, so that could be something to think about. But I just don't know, as far as practical matters, how is this going to help our clients at this point to know that possibly this is coming up.
I would say tax planning for 22, none of this will be applicable. So this is all the potential that they put on the table for last year, and they're not changing any of this. The potential for the unrealized gains on death would be involved with the changes in the estate taxes. And again, I don't think that that's going to be coming around until 2025 what our research indicates is that there's nothing in the Ways and Means Committee for any of these changes right now. So we'll hear more probably in January, but nothing will be effective for 22 for this year's tax.
Sounds good. Okay, great. Thank you everybody for coming to the seminar. We have time for, I don't know if we have time for questions. It looks like we've run over, and I apologize for that. And I thank everybody for their patience. And I hope, my deepest hope is that we have actually given you something you can take with you and use, and would be actually of some help. So thank you again, everybody, for coming to the seminar. Morgan, are there any questions that had come up, or are we good?
Yeah, we do have one question so far. And the question is, what was the issue you mentioned with the health deductions, and how can we use them better?
Okay, let's go back up to that. So, well, the issue with the health deductions, let me just go back up to the related slide. So I think we were talking about health deductions here. The issue is we're told, and this is the same with the charity deductions, and I see this over and over again. People have been told so long that for years and years that, hey, these are deductions on your taxes. So everybody thinks that when they go out and they get the medications, or they give a lot of charity, and it's not that we don't want you to give to your charity, we do, but we just want you to understand that typically in the last few years we haven't been able to utilize these deductions, and even as hard as we try, because of the standard deduction has been raised up so high. So typically they'd be itemized, but most people, like I said, can't take advantage of that. So I just want to get it out there so that people understand that when people say, hey, donate to your charity, it's deductible, it's rarely deductible these days. I don't see it hardly at all on the taxes. And the same with the health insurance, or the health, not the health insurance specifically, but health care expenses. Unless you have tons of these expenses, you're just not gonna be able to take them. And we have even $1 million clients who want to contribute 20 million, or like 20,000 a year in charitable contributions, and we have to let them know, well, that's good, but it doesn't look like it will affect your taxes. So we want you to contribute, but we want you to also understand that a lot of times we can't take advantage of these deductions anymore. So that was the kind of importance. I think that's an extremely important point, and I hope that's of help. So we want to move the charity off the Schedule A. One way to do that, I think, might be to if you're getting some kind of benefit from it, like they're doing some advertising for you or something, then maybe you could reclassify it as advertising or something. It's just an idea I'm throwing out there. But it's a lot of money we're spending on these things. It would be nice if we could take advantage of it. Good question.
Okay, thanks, James.
Yeah.
Next question. My company is owned by myself and one other family member. The other family member wants to be bought out. Is it better to do a stock redemption, company buys back the stock, or a stock sale? I buy the shares from selling shareholder for tax purposes.
I can answer that one there. It just depends on how you want to tax the exiting shareholder. The exiting or the selling shareholder would have pure capital gains on the value that you pay for those shares of stock, and that would be considered acquisition of additional common stock, which would allow you no increase in basis for depreciation purposes or anything. So you're caught between a rock and a hard place, and it requires an analysis of what the dollar amount would be, what type of assets would be in this transaction to see what the value would be if you could benefit by buying the assets of the company or the business as opposed to just the stock value. There's also things called step up and basis that you could do on the acquisition. So for the seller, it's better to sell the stock. For the buyer, it's better to do some other type of computation in the acquisition.
Thanks, Ed. Next question, and this appears to be our last question, so if anybody has anything else, please stick it in the Q&A or chat box. What about contributing a big amount to a donor-advised fund for Advantage for 1 year?
Good idea. That's a charitable contribution in the year that you do it, and you would be able to guide your whatever your entities that you want to donate to with that. I'm assuming these are charitable funds. You can also, depending on what the size of your contribution that you would like to do on that, you could create your own foundation and donate to that. For instance, if you had substantial funds and wanted to have a $1 million contribution into your own foundation, you could go through that, get the deduction in the year you create that foundation and write that check, and then you're required to give up to donate to charitable organizations 5% of that fund balance each year. So, if you had many people do this in a substantial, maybe a sale of a business or something like that, where they could do it. And so you could do your own or go through donor advised, and there's many of those community foundations that are around.
Perfect, thank you. That appears to be the last of our questions, but I did want to let everybody know that I'll be sending out this presentation to you via email in case you missed anything, or if any questions come up after the fact, please feel free to reach out to us and ask them. We'll get those addressed to you in an email, or if you need to schedule your tax planning meeting, you can also reach out to us and we can get that on the books. But we appreciate everybody taking their time today to join us for this webinar, and know that we're always available for any questions you might have. So thank you again, and I hope you all have a great rest of your day.
Thank you, and have a great Thanksgiving, everybody.
All right, thanks, everybody.